Ray Dalio just made a dire stock market prediction. Here is his portfolio now. Recently, Ray Dalio posted on his LinkedIn an article titled "The World Has Gone Mad and the System is Broken." Now, as the manager of the world's largest hedge fund, when Dalio speaks, the market listens. And in this video, we'll be breaking down the implications of Dalio's predictions on the stock market and how it affects us as investors. In addition, we'll take a look into Dalio's most recent stock portfolio according to his 13F filing to see how he's positioning himself and his firm Bridgewater Associates to successfully navigate future markets. We have a lot to cover, so let's just jump into it. But if you're new here, take a second to subscribe to gain access to more content like this in the future. We'll start out with Dalio's article posted on LinkedIn, which is really worth a read if you have the time, and I'll post the link to that in the description below. Now, I won't read the entire article, but it's such a concise and well-written piece that I do think it's worth the time to break down specific sections on the points Dalio's making. Starting with his first argument about why he thinks the world has gone mad. Dalio's observing that right now in global economies, money's effectively free for those who are creditworthy. The reason for this is that investors are generally willing to lend money to creditworthy individuals for very low interest rates, and in some parts of the world, actually negative interest rates. Now, we're currently already experiencing very low interest rates in the US, as seen by the near record low on the 10-year Treasury note. But if you go and look in other parts of the world, especially Europe and Japan, in many cases, if you lend money in those countries, you're actually going to be paid back less than you lend out. In a sane financial world, this would make no sense, because in that case, you're better off just holding the cash because it's better than receiving less cash in the future. Now, the main reason why all of this is occurring is because central banks around the world are printing money and using that money to buy up financial assets. If you look at the balance sheets of the major central banks in the world, they've all been on an upward trend since the financial crisis. This means that over the last 10 years, these banks have been printing money to buy up financial assets in an attempt to spur growth and inflation. However, the issue is investors who are receiving this money aren't really wanting to spend it because they have really no need to, so they want to invest it instead. However, the end result of this is that this ends up pushing up financial prices, which is beneficial for the owners of those assets, but on the flip side, it also lowers the expected future rate of return for investors in the long term. And the issue is this isn't just for bonds, although it's most obvious because they have a stated interest rate, but it applies to all other asset classes as well that have been affected by this, including stocks, private equity, and venture capital. And the effects of this are something you can already see evidence of right now. Specifically because investors have so much money to invest, now more than at any other period since the dot-com bubble, you have a record number of unprofitable companies coming to IPO. And the thing is, in this cheap money environment, the founders of these IPOs don't really care or need to have a plan to get to profitability because money is cheap and valuations are so high, they can simply sell their shares to other investors who have money to burn. This works out great for the founders of these companies, but not so much for any retail investor who decided to buy these stocks. Take a look at some of the most recent IPOs of 2019, for example. Now, keep in mind, these companies stated in their S1 filings before IPO that they may not ever be profitable companies. So the risks are evident right there, but there's just so much money chasing the hope and potential of the next big thing that they don't really take these risks into full consideration. So Uber, for instance, is down 37% since IPO, Lyft, a very similar situation, down roughly 46%, and Smile Direct Club, another 2019 unprofitable IPO, also down 46%. So these are just a few examples of what happens when you have too much money in the system. Now, it's great for founders who can cash out to cash in on this huge overvaluation, but what retail investors didn't realize when buying up here was the true magnitude of downside risk that was actually present. This gets into another issue, which is that there's so much extra capital floating around that some VC or venture capital firms are actually forcing companies to take on money even when they have enough and don't really need it. If those startups say no, those VC firms can go and take that money to a competitor and provide that other company financial support. This can create a situation where you have many startup-like firms all competing in a very competitive environment, but none of them are actually making any money. While all this artificial competition funded by cheap money is a bad thing for long-term investors in these firms, it's actually a pretty good deal for customers. Take Grubhub for an example. Now, this was a company that IPO'd 5 years ago and hasn't really made any money for investors who've held the entire time. Yes, there were periods of heightened expectation, but those expectations finally came back down to reality. The company has a price to earnings ratio of 900, meaning they effectively make no profit. Now, part of the reason for this is that investors are subsidizing the very high acquisition costs for new customers. Putting that into understandable language, Grubhub will offer you $12 off on a $15 order. So effectively, if you're a new customer, you can get $15 of food for $3. Now, I don't really eat out that often, but when I do, I sign up for a free Grubhub account, pay $3, and have Grubhub shareholders cover the rest of my bill. So getting back to Dalio's article, the first argument is that there's too much excess capital in the system. This pushes up asset prices and pushes down future expected returns and causes distortions in the market like we're seeing with so many profitless companies. And the second issue that Dalio sees is that at the same time, you have governments racking up very large deficits. Governments are spending much more than they're bringing in taxes, and as such have to issue the difference as debt. Now, under normal circumstances, the market would look at this and say, well, these governments are issuing more debt, but they really haven't improved their financials. This is probably a riskier investment and we should charge a higher interest rate. However, the issue is that governments are in such debt that they can't afford paying higher interest rates. It would effectively bankrupt the whole system. So what they do is they ask central banks to step in and buy the government debt to help keep interest rates artificially low so they can continue spending even more than they take from their citizens in taxes. This graph visually represents the situation we're in, and it's a very scary graph, to be honest. This is the amount of annual interest that the US has to pay on their debt. The issue is that the interest that we have to pay on our debt is rising much faster than tax revenues, meaning that the only way we're going to be able to pay this interest is to continue issuing more debt. But by doing that, well, then we're going to have to pay more interest, and you can see where this is going. And keep in mind, again, this is all at a time where interest rates are at historical lows. Even with those low interest rates, we have to pay $600 billion just in interest payments. We simply can't afford to pay normal interest rates like we did in the past, which is why we see central bank intervention to help bail out the governments by buying up their debt and keeping interest low. The third argument from Dalio is that at the same time, we have all of these unfunded pension and healthcare liabilities, many of which are coming due, but we simply don't have the funds to pay for them. Now, this isn't going to happen suddenly, but it's going to be a gradual squeeze over a long period of time that's going to eventually get worse and worse. Because of the situation, eventually you're going to have to do one of three things or a combination. Option 1 is you cut benefits. Option 2 is you raise taxes. Neither of these are very politically appealing, which leaves option 3, printing money. This is the easiest for politicians because most people don't necessarily notice this day to day. However, it's important to note that printing money doesn't create wealth, and it comes from somewhere. Either in the case of direct inflation where the prices of the goods rise, or in asset price inflation, while you do see a rise in asset prices, you're taking away from the expected future returns from those assets. Just ask any retiree who depends on interest from fixed income. They'll be the first to tell you that their budgets have been squeezed by the lower returns that they're getting on their investments. And the fourth argument that Dalio brings up is that all this central bank intervention is actually causing more problems with the wealth gap. It's giving so much easy and cheap money to those who are creditworthy and effectively none to those who aren't. The problem here is that central bank money printing is distorting the capital markets that make capitalism actually work. You have too much money being thrown at these profitless companies, which really ought to be invested in the economy more efficiently. So long term, we've got some problems coming up that we're going to have to face at some point. The question remains, what are the implications today for investors, and how can we best navigate the markets going forward in the future? But to help provide a bit of perspective on that, we can take a look at Bridgewater Associates' stock portfolio, or effectively Ray Dalio's stock holdings within his hedge fund. Now keep in mind, Bridgewater Associates is a very diversified hedge fund, and they have investments in all types of asset classes. So when we're looking at this 13F filing with the SEC, we're only looking at their direct stock holdings. This would be individual stock positions as well as exchange traded funds that are listed on the stock exchange. Now that being said, even within the stock portfolio, it's very diverse, having over 330 positions. In this case, we'll be looking mostly at the top 17 positions, which are all exchange traded funds and make up about 80% of the total stock portfolio. But keep in mind that stock portfolio, again, makes up only about 7% of the total assets in the hedge fund. The other 93% are invested in assets that aren't required to be reported on the 13F filing. So let's take a look at his ETF positions. Now, the way I like to think of his portfolio is in these groups. First is US stocks, generally represented by the S&P 500. Then you have emerging market stocks, which are stocks from countries that aren't quite fully developed economically and are experiencing generally higher levels of growth rates than developed countries. This also includes emerging market funds that are specific to a certain country like South Korea, Taiwan, or Brazil. Dalio has also been an advocate of gold, and he owns 2 gold ETFs within the top 17 positions. Compared to US stocks and emerging markets, Dalio holds a much smaller position within developed market economies. Now, while this is the stock portion of Dalio's portfolio, he does own some bond ETFs, at least within the top 17 positions. Keep in mind that he likely owns many direct positions in bonds that wouldn't be reported here. And the remaining 23% are all of the other individual positions in the fund. If you'd like to actually check out that data for yourself and see actually all of the individual companies within the fund, you can use the website called Whale Wisdom. That's what I usually use for these portfolio analyses. So this should help give at least a better visual representation of where Dalio is investing the stock portion of his fund. In this case, he has about a third allocated to emerging markets, a quarter to US stock indices, roughly another quarter to specific individual stocks, about 9% to bond ETFs, 6% to gold ETFs, and a much smaller portion, about 3%, to developed market ETFs. So this is as of the end of September 2019, but what's interesting is we can actually compare this to his portfolio at the end of March 2019. And what you'll notice is that he was a lot more invested, or more heavily invested, in the stock portion of his portfolio in emerging markets. At that point, over half of the portfolio was invested in emerging market ETFs, which gets me to this graph here on the left, which is the portfolio holding changes. So effectively what this graph shows in the blue bars is the current percent of portfolio at the most recent filing. So this would be as of September 30th. What the red shaded area represents is that position's previous percentage in the portfolio during the last filing. So in this case, this red would be in the end of June 2019. So what this means is that when you see a blue bar less than a red bar, it means that position was decreased compared to the previous filing. And we can actually confirm that with the data here, that the largest changes to the fund actually came from decreasing the position in these emerging market ETFs, as well as in the emerging market bond ETF, decreasing those positions anywhere from 20 to 50%. Now, while there was a significant change in the Brazil ETF and also the new addition of a Taiwan ETF index, the rest of the remaining positions in the top 17 didn't really change that much, no more than a 10% difference from the last filing, which means that of the money that was sold in emerging markets, a majority of that likely went to individual stock selections. Now, since we know what Dalio's stock portfolio was at the end of September, we can get a rough sense of how the portfolio has performed, at least until now. So assuming no positions have changed since the end of September, which is unlikely, but unfortunately that's all the information we have, Dalio's portfolio through mid-November is up roughly 2.5%. Now that was without calculating the change for individual stock positions, which I can actually do real quick right now. Okay, I'm glad I actually did calculate that because that increases the performance up to 3.3%. So again, well, this is just 1.5 months of performance. It doesn't really mean anything in the short term, but it's more of a way of breaking down each of the components of the portfolio. So overall, the largest contributors to the return over this period was the S&P 500 index funds, as well as the emerging market ETFs, and then a large portion coming from those individual stock selections. I'll say again, this is just a month and a half of data, so it doesn't really mean anything. But just for comparison, here's the return from Bridgewater's portfolio, the S&P 500 index. And this, over this period of last month and a half, I've had a really unusually high rate of appreciation in the stock holdings of my portfolio, but I'll explain that in a little bit. But overall, now that we understand Dalio's perspective and have seen his portfolio, I think there are a few key takeaways. One is that when you look at the portfolio holdings, they are very broadly diversified across many different sectors and asset classes. This has always been one of Ray Dalio's strongest messages to individual investors, is that diversifying well is the most important thing you need to do in order to invest well. And Dalio is really a man of his words when he comes to that, because he owns effectively at least a portion of almost every tradable stock in the world. Now that's through his ETF holdings, but he also owns a sizable portion of individual stock selections. And keep in mind that this is only 7% of the total assets under management in the hedge fund. That means he has a complete 93% of the rest of the fund invested in other asset classes beyond stocks. While we don't know what those are, we do know that Dalio doesn't put all his eggs in one basket, and I think it's safe to assume that those funds are very well diversified as well. Another key takeaway is that due in part to cheap money and low interest rates, stock valuations, at least in the US, are relatively quite high by historical standards. And as we know, the higher the valuation, the lower the expected future returns, which is why it can make sense to supplement your portfolio performance with individually selected stocks that you believe have a more favorable risk to return ratio than the average stock in the market. If we look at Dalio's portfolio again, individual stocks made up less than a quarter of his stock positions, but made up about a third of the portfolio returns, meaning that relatively speaking, over this period in time, the individual stocks likely outperformed the rest of his portfolio. And finding attractive or undervalued stocks to invest in isn't something that just Dalio and his team can do. You can do it as well, and I'll give you an example from my own individual portfolio. Now, one of the main reasons for the strong performance in the stock portion of my portfolio during this period in time was due to finding a couple high quality but undervalued stocks. And one of the tools I used to help make that determination was a simple valuation model that I built myself. If you're in my investing group, which is the second link in the description below, you can access this same spreadsheet by going to the spreadsheet library and clicking on the valuation spreadsheet. So in this case, the stock that I found that I believed was undervalued was Cigna Corporation. Now, Cigna is a health insurance company that's shown historically strong earnings growth rates in the past and is still expected to continue to grow at above market rates for the foreseeable future. Despite this, the stock was recently beaten down and trading at valuations below its historical average. So I initiated a position in May of 2019 this year and continued adding to my position throughout October. Since then, it looks like the market has caught on and the stock is up about 25% since then. Though I would have been happy if the stock continued to go down so I could pick up a few more shares. So before I bought stock in Cigna, I spent the time to value it within my valuation model to get a rough sense of what the stock was actually worth, then compare that to what the stock was actually trading at in the market. Now, I'll have a more detailed video on how you can actually set these assumptions in the future, but based on my rough estimates at the time, Cigna was worth roughly $209 if you were targeting a 12% annual rate of return. Even now, the price is trading below that, representing at least a 10% margin of safety. However, when I was buying between roughly $145 and $160, this was even a larger margin of safety, which helped reduce the downside risk and also increase the potential upside return. Now, this was a simple one-stage discounted earnings model, but I also built a more conservative two-stage discounted earnings model. In that case, a fair value for 12% returns would be about $164. Right now, the stock is trading above that, but at the time I was buying, it was trading at or below that. So this gave me enough confidence to build a relatively healthy size position in the company because I had conviction that eventually the market would see the value in the stock and the stock price would appreciate to more accurately reflect the true value that the company was worth. Now, it took about 6 months since I first started buying in May to see real meaningful appreciation. In the long term, if you do good valuation work, the market will eventually agree with you, but you just don't know when. So as a complement to staying diversified, making strategic bets in individual stocks that appear favorably valued can be a way to help generate long-term returns regardless of market conditions. Anyway, I hope you enjoyed and found this video interesting. I always like getting a lot of different perspectives, and Dalio's is definitely one to listen to. If you have any comments, questions, or suggestions for future videos, let me know in the comments below and I'll do my best to get back to you. Until then, thank you so much for watching. My name is Michael, and I will see you in the next video.